Okay, welcome everybody to episode 93 of the Volatility Barometer podcast. We are closing in on 100. We will, mid-October. We'll probably finish off and get maybe to 100 by Christmas, hopefully. But thank you everybody for joining today. We've got a pretty good show, I think. Some of you have been emailing me, asking me questions about this, so I will be updating the spreadsheet. Just go over it very briefly. I did make a few additions, and I will also show everybody how to download that completely free. So, of course, interested in that. Secondly, we will talk about Iron Condor trade fees specifically. I always get a ton of questions. Why are Iron Condors so expensive? Are they even worth trading? So I'm going to go over that, talk a little bit about that, and then give you some alternatives if you really are interested in saving as much money as possible. And then, of course, lastly, open Q&A, ask me anything. I'll throw up the old interest board if, off-topic questions. We just very chill on my live streams, pretty informal. Ask me anything. I will try to keep myself out of trouble if you're going to be asking weird questions. I don't dodge them completely. I will answer questions about, politics and whatnot, but I do try to be cautious about what I say because, people can get a little bit sensitive these days on social media. So that is the show for today. I think we're probably going to go for about 1 hour. I'm terrible at keeping them short, but every single time I do a live stream, I do try to keep it 1 hour. I always say we can do more of these more often if I keep them to an hour, but we tend to, I can ramble on for days, as you know, so we'll see. Let's see if we can do that, but let's actually get right into this. I can see in the comment section somebody has said, Happy Canadian Thanksgiving. I don't know why, but it really caught my eye. I'm barely Canadian, I feel like, these days. I didn't even know it was Thanksgiving, to be honest. I have not been a resident of Canada for, since 2000. So, a good 24 years I have been officially out of Canada. And my only real connection is my family, my mom, my sister, and her husband. They still live there. But I told the COVID story about, how they basically forced the vaccination and I got stuck and I had to actually get it to leave because I'm not a resident of Canada. And so that whole thing happened, of course, in 2020. And I haven't been back since. So, I haven't been to Canada in about 4 or 5 years. So we'll see. I'm sure at some point I'll go. But yes, if you are Canadian, happy Thanksgiving to you as well. So let's actually get right into the spreadsheet. So the first thing that I'm going to do here is we are just going to review what is already in the spreadsheet for you. And then I will show a few additions that I made. And then, like I said, I will show everybody how to download this completely free if that's what you're interested in. So the first thing is right here. You can see it says Volatility Data. This is sort of the main volatility data page. We've got the VIX futures going back to 2004. That's when they launched, March 26, 2004. I have also gone, of course, through this myself, and I've been using this for, many, many years now, for 14 years now at this point. So VIX futures roll per day, all the days to expiration. And then this is what I call the cash VIX term structure, the VIX 90, VIX. A lot of people know what the VIX index is, but they might not know that there's actually VIX-style indexes for 9 days, 3 months, 6 months, and 1Y. And the relationship between all of these 5 actually also forms a term structure, much like you would see, say, at VIX Central for the VIX futures. This cash VIX term structure is also extremely important. And I've got many videos showing why, but you've got all of that data going back as far as it goes. Throw in the VVIX. As you know, I don't love the VVIX. I don't use it for a whole lot. The volley is actually quite good. I think it's actually better than the VIX because the VIX index measures all strikes basically of SPX options, whereas the volley is just basically at the money options on the SPY itself. Now, the only reason the volley isn't more popular, the VIX has the brand name, the VIX has the legacy, it's the first mover principle. The VIX has been around forever, but actually the volley is quite good as well. You've got that. And then these are all the indexes that these volatility ETPs are based on. You've got short vol and long vol. This is for things like SVIX and UVIX. And then you've got the original SPVIX STR. That's the most important one. That would be for the VXX. And little quick note here while I just remind myself of that. The SPVIX STR index actually did a, somewhat of a split here. They multiplied everything by 10,000. So these numbers are going to be significantly larger than your old spreadsheet if you have downloaded previous versions. This is now basically split adjusted to the updated numbers, right? This was getting awfully low before, so they have done that. If you got the other ones, this is essentially just for people who, when you're doing your back testing, if, for example, you didn't want to use the ETFs directly, because there's a few times where they can deviate from their intraday indicative values, what they're supposed to be tracking with the indexes. So to be the most accurate, you might want to do your back testing over here with these numbers, but nothing wrong with using the products themselves. They function extremely well. And of course, these are all back as far as they go. So, simulated all the way back to 2004 in most cases. The UVIX and the SVIX goes back to December 2005, but plenty of data for people to do all their testing. And then again, quick reminder here, I added the SVOL this month, or this quarterly update, and SVOL data doesn't go back very far. I will probably contact them and see if there's any back test that they have done, some type of simulation back further. I'll see if I can get some extended data for that. And then, of course, the old and dead ones, they're there. They terminated in the past, but we've got that data as far as to the dates they were terminated. So that's the main page. And then I just kind of organize things for people. So this is the VIX futures, of course, very important relationship between M1 and M2 VIX futures. Every time somebody is going to be going to VIX Central, probably get the ad blocker going up here, but basically the relationship between the front 2-month VIX futures, this is a very common thing for traders to be looking at. And so, of course, we've got that. And then I have organized it back to 2004 just so that people can get a snapshot view of what's going on. And I also went ahead and did the deciles for everybody as well. So every 10th percentile of all those values back to 2004. If you just wanted a snapshot glance, you say, hey, what is the M1, M2 VIX futures contango? 65, 70% of the time. You can just, if you wanted the fives, or even you could go further than that and do the 1 percentiles if you wanted, but just a snapshot view of the contango backwardation levels. Interesting to see. You can see that there's only actually about 16% of it that is in backwardation. Most of it is in contango. And then I've got the VIX index, and this is actually going back to 1986. So the VIX officially launched in 93, but we can use a back test going to 1990, and then we can use actually the VXO, which is using the S&P 100 calculation from 1986 to 1990. So we've got actually a pretty good glimpse. And this is interesting because you'll also get the 1987 Black Monday crash, which the old VXO actually went to 172 intraday, closed at 150. So this is actually the long-term VIX since 1986. And again, just for quick glance, you can have all the deciles as well, mean, median, mode. This is interesting as well. A lot of people say, oh, the average VIX is 20. Well, I've got videos on my YouTube channel talking about how obviously the median is much more important than the average, because the VIX can, as we've seen, go into the 80s, and using the old VXO, it can go as high as 150. So that's going to bring up the long-term average significantly. So the mean doesn't mean a whole lot. You're actually looking at the median. And I would submit that actually the mode, which is the most common occurring value in a series of values, you've got the mode at 1242. So a VIX with a 12 handle, right? See, VIX of 18, say, we would call that an 18 handle. A VIX of a 12 handle is actually the most common value. So the VIX between 11 and 14 is a very, very common level. That's what I would consider roughly VIX of 14 to be average. Even though the mean says nearly 20, I would say an average VIX is about 14. Next, we've got something for all of you backtesters, putting portfolios together, trying to measure benchmark comparisons. I've got the S&P 500 Total Return Index, so this includes all dividends as well. This is total return, going back to 1990. And then I also included the Total Bond Index to the same date, 1990, and spot gold, daily calculations going back to 1990. So you've actually got all three of those, plus a 50, 30, 20 benchmark. And anytime you're doing your back testing, you can just put this against your test. And this is essentially what you could call, in air quotes, you can't see me, but air quotes, the market. So this is the broad market. You can see a 50, 30, 20. since 1990 has actually made 7.4%. Back out about 4% inflation. Not overly impressive, right? Most investors out there are barely beating inflation. Obviously a big problem. That's why there's a big retirement crisis. You know, people say, oh, I'm getting 8%. Well, 8%'s like 4. And then if you use real inflation numbers, it's probably closer to 2. And then people make mistakes in a crisis and it goes to 0. You can understand why people have difficulties investing. But here's all the values there. I think this is super important just to have a standardized benchmark that everybody can use. And then I do crypto data as well. This is Bitcoin back to 2012. The interesting thing I'll mention here is that these are trading days. I went through the entire data set and I actually made sure that it matches up to trading days of official market days. So, you know, of course, Bitcoin is going to have prices continuously, even on weekends, but I have actually excluded all weekends, all holidays. So you can just take these numbers and just slap them directly against any other trade for a market ticker, like stocks or bonds or whatever you're doing. And it's going to compare actually exactly. It's going to line up exactly. So very tedious to do all of this, but I've done that for everybody. And then I did the same thing for the Grayscale ETF as well. This, I think, launched in 2015. So that starts here, but you've got that crypto data. And then lastly, we've got inflation. Anytime you're doing testing and you're trying to benchmark to things, it is a good idea to back out inflation, right? We've got inflation back to 1913. I've got basically the raw number for the CPI, and then the month-over-month values, the year-over-year values. And this video here, I would encourage people to watch this because it's a video where I'm talking about how the actual inflation rate is significantly higher than the Fed is saying, right? So I made a specific point to say that, remember, this is Federal Reserve data. This is the official numbers. But I think we can all agree that the actual inflation rate is significantly higher than what they're saying. So all you do is just click
It blows my mind, but for some reason,
and these will all go directly to the page. So let's talk about the 3 pages that I've added since you actually last saw this spreadsheet. So the first thing that I added was I added the Volatility ETP Landscape course. Now this is technically free for everybody who wants to get it, but it's all organized here for you, right? VTS community members have a library of courses that they have access to. This is, of course, in there, but now it's in the spreadsheet as well. So you can just go here.
So
Again,
I'm not exaggerating.
click on the video, and it's going to take you right to that lesson. And then what I said down here, just, you know, as you're watching these, I would encourage people to do that. Just, you know, pick a color, highlight it green, and you'll know that you've watched that lesson, and then you go to the next one. And right now, currently, this is going to teach people basically every aspect of how volatility ETPs actually work, right? The functioning. This is talking about how they don't actually suffer from the old buy low or sell low, buy high problem that everybody thinks they do. That is a total myth. And then you've got how they actually work with the roll yield, what beta slippage is. And this course is just going to keep going. So as an example, this course here, this is for the community. All VTS members, just paying subscribers, have access to this course. And you can see there's 6 lessons already up to the beta slippage, but there's going to be many more. I've planned these out. Might not be in this exact order, but we're going to do actually a pretty extensive course here. And I'll just keep adding more to it. I'm sure there's going to be many more, but you're going to have the course. And every quarterly update, I will include that. The second thing that I added is my Total Portfolio Solution course. So if you are interested in what I personally do as an investor, my portfolio exactly, you can go through this course. This course is going to be quite long. I'm going to basically A to Z on everything that I do. So again, you can click the link or you can click the picture.
Welcome everybody to Volatility Trading Strategy.
So welcome to the course. And those are all here as well. So these are my strategy videos. And what lesson are we on now? We're up to lesson 10. So again, just a quick note, this is going to be a very extensive course. This is the Total Portfolio course. We have gone to lesson 10, but you can see, I mean, I've planned out that this thing is just going to keep going. I've got many video ideas and many more coming. So this is going to be like a 40-part course. Now, just a quick side note, this is my latest video, VTS Performance Score. Now, I actually worked pretty hard on this video. I actually like it. But one of the unfortunate things, let me see if I can do this. Let me just show you my dumb face here while I search the back end of my YouTube. Actually, you know what? There really aren't any secrets in that back end. I can probably show you all of this. That's why I do the live streams. I make sure I only have 100 grand in the account in case I flash my account numbers. Yeah, this is the page. So let me go to screen share. This is kind of disappointing. This is just a little glimpse into the back end of YouTube. Whenever you launch a video, it gives you the comparison of that video based on your last 10. And so if you're a YouTuber, you know the feeling when you go to your YouTube and you check. What you don't want to see is, 10 out of 10. That's actually a really bad score. So if I show you this page, you can see I got the dreaded 10 out of 10, right? Basically means that of the most recent 10 videos that I've uploaded, this is the worst one. This one did the worst. I only got 700 views, and this is through about a day, or what is this, 2 days? Yeah, not great for one of my videos. So, yeah, my essential point was go ahead and give this video a watch. It does appear like very, very few people have actually done that. So give that video a watch for me. I think it's very interesting. I think it's a super important video. I created a risk-adjusted return metric myself. So this is how I measure not only my own performance, but everything else in the market as well. Interesting video. Give it a look. And then the last thing that I added this month is a VXX price calculator for everybody. So this is going to be fairly useful for option trading specifically, but we've got all the VXX levels back to 2004. Of course, the daily changes here. This is all just for your own personal testing. And then this super basic thing, we're basically just doing a regression back to the 2004 to see how much it daily decays. So all you do, I have a little how to use thing if you need a reminder there, but you basically just adjust this number until the end price, right? This is the third quarter 2024 value as of the most recent update. When these two numbers match up, that is the regression back to the beginning. And you can see that the VXX actually decays 0.254% per day. So then what you can do with that, of course, if you're an option trader, you can put in any numbers you want, but of course, most useful to put in the current value and the current decay factor. And then you can see where it's going to decay. This is just based on averages, but it's actually pretty accurate, especially for trading. It's pretty much as most accurate as you could get. Using historical values. So let's say you had, a 20-day option trade, right? You just go to the point at 20 and you can see that it's going to be 47.14 based on long-term averages. It's going to hit 47.14. So whatever trade you're doing, you might want to set your strikes somewhere close to that range and you can capture that price. Or if you're doing something where you're like, you know what, I don't want it to get to the strike. Maybe I'm selling a short put option on the VXX. I know that in 20 days, it's on long-term average, it's probably going to be about 47. It's 49.60 now. Maybe I'll set my strike a little bit lower because I don't want to get assigned. So maybe I'll throw it down to the 46. Not saying it couldn't get there. Of course, it fluctuates up and down. But this is a pretty good general benchmark for people just setting their option strikes. And then I've got the 90-day as well, just in case it's a longer term, and a 3-year path. So as we know, just a little side note, that the VXX typically does a reverse split roughly when it hits about $10, give or take. It's actually about $11 is the long-term average. So you could, if you wanted, if you were just curious, when is that going to happen? Well, it's about 610 days from now. So there's 252 days in a trading year, right? Minusing weekends and holidays. So you're talking about, 2 years and a bit. There's going to be a reverse split, give or take. We'll see what happens. But again, if you forget what to do, there's a little, reminder here how to adjust the axes and whatnot. So that is actually your updated spreadsheet for this quarter. So obviously anybody can email me and say, hey, I'd love if you add this. If it's proprietary, obviously I'm not going to do that. But if it's something that I can add and people find it useful, absolutely no problem. I will do that. So the last thing, just really quickly, I want to show people how to download this, which would be great if you are trying to get this data spreadsheet. This is not something that anybody really gives, especially for free. But, I want to help everybody out. So what you are actually going to do, now this is a small favor to me, a little small ask, but you're going to go to my website, volatilitytradingstrategies.com. And again, this is free. You can do this for free, but go to the subscribe page. And as you will notice on the subscribe page, it says monthly subscriptions receive a free 2-week trial. So you do get a free 2-week trial for this. You don't actually have to pay to get this. But of course, you know how social media works and whatnot. And also just a little ask for people. Just give my work a little peek while you're, blazing through this. But what you will essentially do is you will subscribe to VTS For 2 weeks, you'll be on the free trial. And then from there, you will be sent a password so you can actually log into your course library. Now, some of these courses, this is my end, so I'm the administrator here. All of them are visible, but not all of these courses are uploaded just yet. Some of them I'm building out. Some of them are just plans for the future. But there's about 6 of these that are actually public courses. And the one we're looking for, this one is public. This one is public, of course. These 2 are both public. This one is Volatility Landscape. Dashboard will be coming soon. You get the point. Not all of these are public. Total Portfolio, that one is public. This one here. So you're looking at the Volatility Data Spreadsheet course. You will be able to jump into this as soon as you sign up for your free trial. So on day 13, you'll get an email with your link. But if you want to expedite the process, you can just go directly to your course library, go to lesson 1. And I tried to make this as simple as possible. You just go to the lesson, click download right there, and you will get your spreadsheet. And you can get that after subscribing for, I would imagine within a minute or 2, you'll have your spreadsheet. Now, from there, how long you want to stick around with VTS, that is entirely up to you. A lot of people just stick around for years. They just like my portfolio. They like the way that it works. It is relatively low stress. We do focus more on drawdown reduction rather than chasing big gains. So long term, you start to see the effects of this. And a lot of people just stay for many years. But if it's you and you're just passing through for a few months, learn everything you can, dive into the courses, consume all the content, and then, head out somewhere else, you are obviously completely free to do whatever you want. So that is your spreadsheet update as of now. Now, that was I didn't actually look at my front end here, but my eCam here says there's 4,000 people watching right now, which is impossible. There's usually between 60 and 100 people watching live. So obviously my software is struggling with something. There is absolutely not 4,000 people here. What a huge turnout that would be. What would I be talking about to get even, I think my peak all time is like 200 live viewers and something like 6,000 views, over this time span. I mean, that feeling where I just looked at that and it said 4,000 people, that's the dream. Who wants to help me get to 4,000? First of all, obviously subscribe to the YouTube channel. That'll help out a lot. Give the video a like. YouTube will know that it's pretty cool stuff and it'll disseminate to everybody else. But God, how am I going to get 4,000 people watching my videos? That is crazy. So anyway, let's go on to number 2. Okay, so this one is actually coming from a question from somebody. And great question, but to be honest, not a very uncommon question. I get this one quite a bit. So the question is, Schwab charges 65 cents per contract. And that's pretty fair, right? That's pretty reasonably accurate across the board. Some brokers are cheaper than others, as I'll talk about in a minute. But he says this seems fair until we factor in that you use a 50% stop gain for the trades. And these are Iron Condors specifically. Doesn't that make the trade fees too large a portion of the potential profit? So this is a great question. I get this all the time because, of course, an Iron Condor is a 4-leg option spread. So when you're trading, say, a long put option or a long call option, something very basic, you're only paying trade fees per contract. And so options doesn't necessarily get more expensive or cheaper because it scales a relative level. So if you have $1 million account and you open an Iron Condor compared to someone with a $10,000 account, it's the same relative impact. Because these days we don't pay to open the trades anymore. It used to be, $9.99 to open, $9.99 to close. For smaller accounts, that was very prohibitive, right? If you're paying $20 every trade, no matter what, even if you're trading one contract, that is a huge penalty. But these days, because you've got a situation where it scales based on contract size only, now it no longer matters. But people start to get a little bit nervous when you're talking about an Iron Condor, a 4-leg option where you're paying for all 4 legs. So even a single contract Iron Condor, you're paying 4 option contracts for 1 actual contract. And then we also close every single one of our trades, either for a stop loss or a stop gain. We trade long dated contracts, and they're always going to either stop out for a gain or a loss. So double that up. So now you're talking about 8 contracts for 1 Iron Condor. So the question is this too much? Now, I do want to actually draw attention super quickly, just for anybody who is interested in my actual course. This is, again, something that I would imagine if there is something like this that exists somewhere else, I would imagine that it costs quite a bit of money. I have put together a Iron Condor video course that, again, is just offered within the VTS community. There is no upsell of any kind here. And technically speaking, you could get it for free for 2 weeks and then, head out the door if you wanted to. Hopefully people don't do that, but you absolutely could. It is technically totally free. This is 30 videos, right? There's 30 Iron Condors here. I think I've got a picture of it here as well. This is the Iron Condor course. All of these videos basically are done. There's only one that I haven't done. And every time somebody gets, really common question comes up, I'll throw on another video and answer that question. So eventually this will be a much longer course. But 30 videos, it's like 5 hours. And look, every single one of those videos is actually edited down. They're not just me talking on a live stream that's burning a lot of time. This 5 hours of tight edits. So definitely check out that course. But what I was going to say is there is a lesson in that course specifically talking about this, but I'm not going to just punt and say, hey, go download this for, do that. So let's talk about it. So the one thing that I would say, first of all, I'll say 3 things about this fee issue. The first thing is trading is trading. Trade fees are part of the game. This is just what we do. Now, it is true that trade fees for an Iron Condor do seem high, right? But you have to remember that it is a very high probability trade. If you're talking about single leg or 2-leg options, these are very, very low. Well, not very low, but much lower probability of success trades. When you get into the 4-leg options, such as butterflies, technically 4 legs, Iron Condors, 4 legs, now all of a sudden you're talking about high probability trades. And so, yes, it's true, you're going to be paying fees to open and close, but fees are pretty cheap. 65 cents is reasonable-ish. Back when I started trading, I was with Toss back in 2006, I think, when I first started. I don't even know if it was called Toss back then. It was obviously Ameritrade. But yeah, it was $9.99 to open and close, and it was 75 cents per contract. So back then, it was actually quite prohibitive on expensive or on lower account values. And so I actually, back at the time, went to Interactive Brokers, which was significantly cheaper. And I've only recently, come back to Toss because I just like it way better. Interactive Brokers is the ugliest software in the world, bar none. And so, it's worth a little bit of extra for me to just not have to look at that absolute mess that they've put together. But 65 cents per contract is very reasonable. So fees are fees. It is part of the game. It is a high probability trade, so you don't have to worry about it. The second thing that I will remind you is if you are concerned that you're looking at some type of track record for me, for our trades that I send out in our emails, you have to understand that every single thing I do performance-wise is already accounting for fees. Fees are already deducted from every trade. Entry, exit, options, all of it. Dividends taken out, everything is adjusted correctly. So whenever you see a performance stat for anything that I'm showing you, trade fees are part of that. So it's not like you have to go in there and say, well, seems okay, but I got to deduct 2 or 3% because there's trade fees coming out of that. No, it's actually not. So this is the strategy as it is. And just quick reminder, I have only just recently, in the last few months, started including the idle cash into a, short-term treasury ETF. Even though this is something we've always done, I never included it. So our performance is probably a couple percent higher, but I don't go back and change any numbers. So it is what it is. But performance-wise, we are talking about, roughly 17%, and that is fees already deducted from it. So don't worry about that. Fees are part of the game, and I am not trying to deceive anybody by getting you into really expensive trades and then, hey, by the way, here's our performance and yeah, it's not nearly as good after fees. I don't do that. Everything that I show people is the live record as you would an actual subscriber to VTS. So I wouldn't do that. But the last thing that I will show you really quickly is there are actually, if you're still concerned about this, there are a few ways that you can actually reduce your fees. So let's talk about that. Again, I will say there's an entire video lesson in that course talking about this, but let's just go do it really quickly here. So let's do the S&P 500. We trade about 45 to 75 days. So 70 days, this is a pretty good range. You're going to learn a few things about how I personally trade Iron Condors here. So 45 to 75 days. I like long dated contracts because they are safer, right? The gamma is very low if you do long dated contracts. And if the market does something crazy, the impact of that is not nearly as significant. So I do like the longer dated contracts. And then we also do roughly 15 delta on both sides. So we can find that somewhere around 530 on the put side. So we're just going to open a standard Iron Condor. So 530, 525. And then we will go, the call side's over here in toss. So we'll go, here's the delta column. We'll find that 15 delta. You know, you don't have to get exactly. It looks like the 620, somewhere close to there. So let's do the 620 and then $5 up, which is what we typically do. I'll talk about why in a second. 104, that's a little bit low. Sometimes you're in between. So let's do 535, 530. This one should be fine. Okay, $1.10, doesn't matter. This is a standard Iron Condor. Ours are probably closer to $1.20, so I might even bring that in one more strike, but this is just fine for the example. So this is what it looks like. Now, for me, I will be using a 50% stop loss, which means the premium we bring in is $1.10. Let's put it at $1.10 and lock it. $1.10. So when this thing hits 55 cents, that is a gain, right? When Iron Condors go down in value, you're making money. So when it hits 55, that is a stop gain. And at 55 cents, I'm out. I'm going to take my profit and get out of the trade. 55 cents on the upside is $1.65. So at $1.65, if the premium gets that high, that is the stop loss and I'm out. So no matter what, this trade is going to be closed. It's basically 50-50, right? A lot of people complain that, oh, wow, Iron Condors are terrible because the gain is so much smaller than the loss. Yeah, it doesn't matter. We don't hold these to expiration. This turquoise line is the expiration shape. All we care about is this pink line, the daily profit. This is a 50-50 trade from my perspective with my stop loss and stop gain. So all I do is just get more winners than losers and you make money long term. But the point is, this is a standard trade, and how I price these, I use a 3% of total asset value. So, of course, you could just eyeball it here, but let's say a person has a $25,000 account. They're going to use, hopefully you can see this calculator. I think you can. If not, I'm using a calculator. $750 is what I can allocate to this trade. So all you do is look at the max loss of $750, which you can hover over here. Basically, that would be 2 contracts. $780, close enough. Now, if you want to be a real stickler, then you'd go to 1 contract. But let's just say for this example, $780 is just fine. Another thing you can do is just take that $750 and divide by the max loss manually. So the max loss of an Iron Condor is the strike gap minus the premium. So $5 strike gap here. You can use put or call side, doesn't matter. $5 strike gap minus $1.10 is $3.90. So you could just deduct $3.90 and you would open 1.92 contracts. Now, again, if you are a stickler for this type of thing, open 1. If you're not, just 2 is close enough. So this is the Iron Condor. This is 8 legs to open and 8 legs to close. So that scales relative. So $1 million account might open, hundreds, I don't know. But they would open a lot, but it would scale the same. The relative value is the same. There's only 2 things that you can do to actually lower trade fees. One of them is to increase the strike gap. So I'm going to show you an example of what that looks like. So kind of remember this value, 2 contracts, max loss $780. If you were to just go in here and make this $630 and make this $525, that is a $10 strike gap now. Look what happens. Now the max loss is $1780. If I drop this down to just 1, the max loss is $890. So a person on a $25,000 account size now, doing it the way we do at VTS with a 3% total net liquidation allocation, you couldn't even open one contract. So this is for people with a larger account size. So the reason that I do it the way that I do it is because I track all performance at VTS based on a $25,000 model portfolio. I would imagine that a large chunk of our community has, 10 times that at least. But there's many, many traders out there that are on 10,000, 20,000. I want to make sure that everything I do, every single person can trade this. So everybody on every account size can follow the VTS community. And I make sure that we are only using ETFs and indexes and whatnot. So anybody in any account type, it's IRA friendly. You can do it in tax sheltered accounts. Even Iron Condors, you can find plenty of brokers will allow you to open Iron Condors inside a tax sheltered account. And then, we can do stock replacement for people who are in the European economic area and they can't actually hold American ETFs. I try to make VTS accessible to everybody. And so I use the ETF version, the SPY, the Qs, the IWM, the TLT, GLD, things like this, and $25,000 account size. So we're typically opening about 2 contracts. If you're on 500 grand, well, you might want to increase the strike gap, right? You might want to do that. I don't personally really see a point in that because actually it does slightly change the risk factor as well. Wider strike gap makes the trade slightly riskier. So if the market moves very quickly, this trade might lose a little bit more money a little bit quicker. Insignificant, but not zero. And it probably accounts for the trade fees, to be perfectly honest. You can just assume that the markets are roughly efficient. And yes, maybe it's a cheaper trade, but you might lose a few bucks extra if it goes badly. But you can do this. So if you don't like looking at that super high contract size, if just expand the gap maybe to a $10 strike gap. This would be the first thing that you would do. And then look, if you were doing 5 contracts, that's a $4,500 loss. You're talking about a pretty large account size already at that point. You're talking about a couple 6 figures basically at that size. So that's one thing you can do. This will legitimately lower the contracts that you have to buy. The second thing that people can do, and this is only if you have a really big account, but you can trade the indexes. They are materially the same thing. So you can trade the SPX, and this is essentially 10 times the notional value of the SPY. You can see the SPX is 5,800 right now, and the SPY is 578. So it's basically the same thing. It's going to move the same, but you can imagine that if you're trading something with 10 times the dollar value, you will already be having 10 times less the contract size. So basically your order of operations here for reducing your trade fees. Number 1, increase the strike gap on the ETF by like $5 on either side. Or if you're trading the TLT, maybe just $1. Just increase it $1 on either side. GLD, same thing. That would be fine. That will cut them in more than half already. If that's not good enough for you, no problem. If you're on $1 million account, maybe something even more than that, you can trade the indexes. And again, for the indexes, for the SPX, the QQQ, and the RUT, the RUT, I typically use $25 strike gap. So that would be your third level. All right, first level is ETFs like you see in the daily email. Second level, just bump it out $5. Third level, use the index, $25 strike gap. Fourth level, if you have a huge account and you really want to reduce them, then again, increase the strike gap. On the SPX, if you were to do $50 strike gap, you're talking about reducing fees an enormous amount, probably, many multiples less than what we do here. So you could do that. Again, like I said, if you understand how the Greeks work and if you understand risk-reward ratios changing, right, the further those long strikes get away from the short strikes, the riskier the trade gets. So you are essentially trading lower fees for slightly higher risk. Is that really worth it? At the end of the day, is it really worth it? I don't know, but you're going to have to actually decide that for yourself. But again, whole video in the course, breaking that down. You can rewind it. You can watch it again, no problem. Courses are always better, but I did want to talk everybody through this because trade fees is something nobody wants to pay, but how are you going to avoid it, right? What I would recommend people don't do, and I can't tell you what to do or what not to do, but this is just a personal recommendation. I would say stick to the main brokers anyway, right? Schwab, 65 cents. IB is going to be cheaper. Interactive Brokers is going to be, 40, 50 cents. Depends on whether you're adding liquidity or not, but it's cheaper than toss, but not a whole lot. I would stick to the main brokers. It might be tempting to go to one of these super low cost brokers that, yes, you can find them. They'll have 25 cents or 10-cent contracts, whatever they are. They might even call it free, right? They're going to get their money somehow. So they're going to charge you for data feeds, or they're going to sell your data to somewhere else. They're going to get their money somehow. So cheap fees are not cheap fees, right? Always know that you're paying them. They're a bank. They don't do anything for your benefit. So if it looks cheap, it's not. But I would stick to the main brokers, stick to something with good customer service, stick to something that gives you really good tax forms, and all of these things are important. So even though, yeah, it's technically true, you could go online and you could, head to head, the 10 brokers, find the cheapest one, I would advise people to go to not really do that. Just pay your trade fees. This is what it means to be an efficient option trader. Trade fees are one of it. I've always talked about how to be a great option trader, it's not about finding that home run trade that, 10Xs and whatnot. It's about, I call it 1.1. Basically, I tell the story. I used to be a professional golfer, and pretty much at my level, at the, the high level professional golf, everybody can do everything. Like your naked eye, you would not be able to tell the difference between line up the best 500 people in the world. Actually, I should say 641, because my highest world ranking was 641. So on the Sony world ranking, line up the top 641 golfers in the world. I'm at the far right of the driving range, but I'm in that 641. You would visually not be able to tell the difference between us. So the only way that I'm going to be able to beat these guys and move down the lane is if I 1.1 them, right? We all get a score of 1 for chipping and putting and driving and mental game and nutrition and preparation and all these things. We all get a score of 1. We can all do it. It's all exactly the same. But you can 1.1 people. You can get super slightly better. And if you 1.1 the competition in all statistical categories, you're Tiger Woods, right? He doesn't visually look different than me, even though you think, oh my God, he must look just like night and day. No, you wouldn't be able to tell the difference. Well, maybe you'd tell the difference between me and Tiger, but basically you get the point. So option trading is the same. It's not about some slam dunk that you can post on Twitter and brag about everybody. Oh, I 10x, that's bullshit. People just do that to grift. But what you can do is you can manage your trade fees slightly better than other people. You can manage your emotions slightly better than other traders. You can choose strike allocations slightly better. You can manage position sizing slightly better. You can understand how your trades fit into the rest of your portfolio a little bit better. You can 1.1 your competition, and if you add up 0.1 increases over 7 statistical categories, now all of a sudden you're way better than everybody else. So trade fees is one of them, but you got to understand that there are trade-offs involved. So I think we should just leave it there. I think people get the point. I just trade ETFs, and fees are just part of the game. I also use Schwab Toss, by the way. So there you go. I don't love paying fees, but what am I going to do? I'm going to call the bank and say, nah, I don't want to pay you. Because then if they made it free, they could do that, but then the data feed would be triple the values, triple the price. So they're going to get their money somehow. Just let them have it and just be a better option trader. Don't waste trades, right? When I'm in a trade, there's a reason that I'm in that trade. I'm not just throwing stuff at the wall and seeing what's going to stick. That's how you get better. And then you can justify those fees. You can say, no, this trade is worth it. I want this trade and I'm willing to pay entry and exit fees to do this. So I always make sure that everything in my portfolio is completely efficient and it has a purpose. And then the fees are the fees. It is what it is. So let's try to get some questions from these fake quasi 4,300 viewers. That's probably, when I check the official stats tomorrow, it's probably going to be like 72 people or something. But got me a little bit pumped up there. Can you imagine the feeling of having 4,000 people listen to me speak? That'd be a pretty big responsibility, to be honest. I might actually have to throw on a suit and tie for that. Let's try to get some of these questions. So a little off topic. I like off topic. They're fun. My live streams are pretty casual, always free. Don't send any money, of course. It just costs you a like. That's free. Subscribing to the channel, that's free. Interestingly, only about half the people that regularly watch my content are actually subscribed, so you could help me out with that. I will hit 30,000 subscribers before the year is up, so that'll be pretty cool, but you can help me get there a little bit sooner. There you go. So off topic, but I know you've touched upon real estate before. Okay. Any thoughts on rent to buy nowadays? Advantage of rent being you can use the down payment money to invest instead. So right out of the gates, you're going to get me in trouble because my thoughts on real estate, you have to understand I'm not a very emotional person. And everything that I do is analytical, numbers, quant-based, just calculate what's the actual answer. So I can tell you, the real answer when it comes to real estate, rent versus buy, is that probably about 70 to 80% of the time, renting is better. If you rent where you live and you invest the savings and you invest the down payment money, you will be better off 30 years later. I've gone through these numbers. I have 2 videos on my YouTube channel showing that. But the reason that I talked about how I'm not really an emotional person is because home ownership itself gives people this incredible feeling of safety. All right. I don't feel it because, quite frankly, and I'm just going to sound like an idiot when I say this, but I have enough money. I don't have to have that feeling of, boy, I better at least own my house because, I got to have something in this world. I don't look at things that way. I just look at things, what's going to make me more money long term? I've got enough today. I don't need the safety and security. I've lived around the world on the road as a digital nomad for like 24 years. I don't need safety. So sometimes when I talk about real estate, I might sound a little cold and callous, but the truth is it's just a straight up analysis. And like you said, the down payment money is what people are missing. Whenever they do the rent versus buy scenario, they always miss a couple of things. Number one, they miss the fact that home ownership is nowhere even remotely close to free. You have to pay property taxes and maintenance. And when it's your own home, you're going to spend way more money on furniture than you ever would have if it was just a rental. When you do, maintenance, you're going to fix things, you're going to maintain things. It's about 1% a year of the house value. People forget this. People forget the fees to move in and out. If you're going to move once every 20 years, you're going to get hit with 4% on that. That's a massive hit already. And then the down payment itself, people miss this point. But if you are getting $1 million home and you need a 10% down payment, say, that's $100,000. What people often forget is on day one, you could use that $100,000 to invest, and presumably you could get, even if you're just going to do this blindfolded, you could get 8% or 7%, right? You could just do some VBanks, right? That makes 7. I just showed you the long term for the 50, 30, 20. That's 7.4. You could close your eyes and get 7, and that compounds. And then at the end of 30 years, your rent is typically going to be less than your mortgage. I know there's going to be people yelling at me like, no, I know some place in Missouri or whatever it is that, the mortgage actually works out cheaper. That's a short-term aberration that will absolutely be closed in the market. Long-term, renting is cheaper than the mortgage payment on that equivalent house. It's just is what it is. Unless you have a massive down payment, then it's not true. But talking about entry-level down payment, normal fees, renting is cheaper. So when you invest that money over 30 years, you are better off, probably about 70 to 80% of the time. So the only time that it's really advantageous to buy a home is if you could lock in an insanely good mortgage rate and you could actually fix that. That would be a good thing. Canadians, going back to Canada, not really a possibility. We don't have the flexibility in mortgages in Canada, and many other countries don't have that either. You can get like a 5-year fixed or something like that, but very difficult to get a 30-year fixed mortgage. But if you could do that at a cheap rate, go for it. Second thing, if you are actually at a lull where the rent to own ratio is pretty skewed, or if house values are exceptionally cheap at that moment, there's going to be about a 20 or 30% of the time where homes are cheaper than they usually are. Or I wouldn't say cheaper than usual because that's a nominal number, but cheaper than it should be, right? Relative to the long-term trend, you're going to get it going like this around that trend line. If you can get a house in the lull, like in a trough of a trend line, go for it. No problem with that. But like I said, 70-ish, 80% of the time, renting is going to be better. How many people hate me? People hate that. There's a couple of hot button topics that even though I could literally show you the detailed numbers I have in a video talking about, including everything, including right down to, the $24 a month for homeowners insurance. Like I included every literal number I could think of. Renting is just most of the time better. People get mad. People really, really get mad. People get mad when you say dividends are stupid. Dividends are taking right out of the stock price. People hate me when I say that. You're taking money out of this pocket, putting it in this pocket, and you think you made money. I don't know. People hate when you give them facts. So hopefully I didn't offend anybody, ruffle too many feathers there, but it is what it is. Who will be win? Wait, I know I'm missing something. No, I'm not. All I can see is 2 comments from you. Hi. Who will be win? Latest bet. I don't know. Sometimes, if there's a big UFC fight, people will ask me what I think because I'm a huge UFC and boxing fan. So let's assume that you're talking about the Beterbiev and Bivol boxing fight this weekend. Huge, huge fight. It's actually an interesting fight because I just learned how to say his name correctly. For the longest time, I've been saying Beterbiev, but I heard him say it, and he says it's Beterbiev, so take his word for it. And Bivol as well. I guess it's Bivol, but whatever. It's Beterbiev and Bivol. Bivol is going to win, if that's what you're asking. I think Beterbiev is just an absolute killer. What is he, 20-0 with 20 knockouts? But he's old. He's like 38, 39, and at that weight class, that's old. So I got Bivol, however you want to say it. Oh, wait, I don't want all that up there. It's noisy. At VIX Central, I note that M1, M2 has been in backwardation for a while. Yes, true. Very, very comical VIX futures term structure lately, huh? Just a crazy shape there. And the midterms appear to be flattening. Also true. Do you see trouble ahead? Cash VIX term structure seems okay in the daily email. So this is the thing. When you look at a screenshot of something, this is why our community, the VTS community, all of you watching my live streams and whatnot, we are a little bit more educated, if I can be slightly arrogant and say that. We are slightly more educated than the average person when we're talking about these things. So it is not good enough to just say, oh, wow, minus 8% backwardation. We should be going long volatility. This is signaling all out calamity because remember, if I can just pull up this chart, this is in your free spreadsheet, by the way. This is why these snapshots are actually quite useful. You can see that the lowest 10th percentile is not that negative. Like, I'm going to take a shot in the dark and say that a M1, M2 VIX futures backwardation of minus 7.8%, I'm going to say that is the 3rd percentile. So 97% of all days going back to 2004, if I'm right on my guess, is more calm than right now. So that should be a long vol signal. Right now it's at minus 8% backwardation. But we know, and you will know that if you go through your course, look at me just plugging everything I've ever done here. But if you go through this course, really this one here, Roll Yield Explained, this lesson 5 is going to tell you that the real number that you're going to look at is the relationship between these two values and the VIX index. That's the real game. So the backwardation number is basically irrelevant. The real game is the roll yield is sort of in that middle range. Now, I will absolutely agree with you. It's a comical looking term structure. We know that's crazy. But the roll yield isn't completely diabolical. Now, it's not good enough to be long stocks. So you can see that, sometimes it is a little frustrating, but when you're a quant trader, you have to follow the rules. And my rules are set out to be volatility targeting levels. And so we've actually been in gold, which has been working fine. XLU has tanked the last couple of days, but I think it's up quite a bit today. And we're also in IYR. And so we're in safety right now. We are not in long vol ranges. Like we are not even close to getting to the point where I'm going to go long volatility, even though contango backwardation wise, minus 8% is all out red alert, basically. I mean, it does get to minus 30%, but that's just crazy extreme. Minus 8% is a big deal when backwardation gets that high. But yeah, it means nothing. Go for the roll yield, and the roll yield is reasonably high or reasonably low, but not diabolical. So again, like I said, if you know what you're looking at and you know how to analyze that roll yield is the number one thing you're looking at, and the cash VIX term structure, I think I've got a picture of that in my email as well. Remember, I said that there's VIX 9D, VIX 3M, 6M, all this super important. You can see it's basically, it is a term structure in relative contango. So it's not all out calamity. Now, you wouldn't be long stocks right now. It is too risky, but it's right in the middle. Like, you should just be parked in safety right now. I'm not overly worried. The market's not in panic mode, not even close, but it is a little bit sketchy. And why wouldn't it be, right? We've got an election coming up. We've got crazy, horrible mess in the Middle East happening. We've got all kinds of uncertainties. Just the fact that stocks do feel very overvalued, and why wouldn't it be? But in general, yeah, it does. You said cash VIX terms seems okay in the email. It does. Cash VIX is okay. VX30 to VIX roll yield is decent. All these things. Adjusted M1, M2 VIX futures looking fine. Yeah. We're in safety. We're not, no green light, no red light. We're just solid right there in the middle. Let's just see what happens over the next few days. What are your thoughts on the divergence between SVIX and SPY over the last week or so? Well, this has been happening to the vol trade for a while. So, I mean, essentially what he's getting at is we've got the SPY, all-time highs, right? Let's use a bigger chart. We've got the SPY here. Why do I have that set up to crazy time frame? It's probably doing a video of some sort. Let's do 2 years to the day. And obviously SPY at all-time highs, but watch what happens when we do SVIX. It's really struggling, right? This is ugly. SVXY. Now, we haven't been in this. We've actually, like I said, we've been in gold, so we're actually doing pretty great. Our tactical volatility strategy, being in safety, has actually made us way more money because our aggressive position is this one, and this one is not good at all. But essentially, this is one of the things that, again, understanding how volatility works, trying to show my face here, understanding how volatility works can actually allow you to make more money. There's a lot of people, let's call them beginners, hopefully I'm not insulting anyone, newer traders, who actually think that the short vol ETFs like SVIX, SVXY, SVOL, and ZIVB being the main four, they actually think that those are essentially a proxy for long the stock market. And then things like VXX, UVXY, and UVIX, and VIXY, of course, and then the midterm ones, VXE and VIXM, it's a lot of Vs. Those are proxies for shorting the stock market, right? Basically the same thing. Oh, I think stocks are going to go up. Well, I could buy the S&P 500, or I could just buy SVIX. They're the same thing, right? Well, they're not even close to the same thing, right? And you will know that if you study the volatility markets. There are plenty of times where there's a massive decoupling between what the volatility market is doing and what the stock market is doing. They do not have to track each other. There's actually only about a 70% correlation between them. So it is positively correlated. Obviously, if the SPY is going up, it is more likely the SVIX is going to go up. But there are 30% of the time where they're going inverse directions. Same thing, the VIX to the SPX. Doesn't have to be the same thing. VIX measures volatility only, variance around a mean. It doesn't measure up versus down. There is no directional bias to any of these volatility metrics. So volatility ETFs themselves, if the VIX futures are a crazy shape like they are now, and like I said, the VX30 to VIX roll yield right now, you can see these two futures are very close to the VIX index. The roll yield isn't positive or negative. So the volatility ETFs with this term structure, they're not going to be going up because they are absolutely mechanical in nature. They are only priced based on what's happening here. It's not buyers and sellers in the market. So looking at this term structure, and it's looked ugly like this for several weeks now, when you understand volatility, you will know that, well, why would it be going up? That's an ugly term structure. It's actually negative. On a mechanical basis, these volatility ETFs are holding a composition of the M1, M2 VIX futures, and they are steadily losing value every day. Whereas the SPY, this is based on supply and demand. So right now, obviously, there are people who think, more people than not actually are buying the S&P 500. That is not what's happening in the volatility market. These are not supply and demand products. They are entirely based on this and how these are moving around and converging to the spot VIX at expiration. So this is the reason that there's a massive decoupling, because this is awful. This is, ugly to look at. This is probably somewhere around the 85 to 80th percentile of ugliness, right? Like I said, it's not the third percentile. It's probably closer to 15 or 20 when you actually know what you're looking at. But yeah, it's going to struggle. So the reason that we have not been in the SVXY for quite a while is because that strategy, our tactical volatility strategy, trades based on how volatility ETFs work. This is not a proxy for long the stock market. This is a specific volatility strategy that only takes into account the actual signals that we're getting with the volatility market. So it has put us in gold for the last 3 months, something like that. I mean, I know July 24th rings a bell, but yeah, we've been in gold for a long time. I mean, where's July 24th? We entered gold here, right? That's where we entered gold, all the way back here. And it's kept us there, not because I'm, some trading genius or something, but it's just because the signals that I'm getting are based on the VIX futures and the volatility market and the cash VIX term structure and the volatility risk premium and all of these measures that we do. We know that vol ETPs are not going to be going up, the inverse ones. They're mechanical products based on basically a formula, and that formula is pointing to losses. So yes, absolutely they can decouple from each other. This is bad. I would say this isn't the worst I've ever seen, but it's up there. It's certainly a fairly large decoupling lasting several weeks now. But yeah, it's absolutely explainable if you actually know. Shows 4,000 on my end too. Well, it's impossible, but how great would that be? I mean, how would yeah. I'm actually entertaining the thought here. No, there's 72 people. Trust me. No. I'm not that popular. Listen to me. I'm a pretty boring guy. Hopefully I give everybody the facts. Hopefully I help everybody become better traders. I try to provide as much value as I can, but there's no bells going off. There's no, I don't have any, dancers in the background or whatever it is. Or I don't bring a bunch of what those shows that do great. You bring a bunch of OnlyFans girls and you trash on them. I don't do that. Maybe that would be a good way to get more viewers, but no, I don't do that. Okay. How does the tactical vol strategy barometer differ from defensive or strategic? Good question. So all three of them are slightly different, and I don't want to give people the impression that they're all totally different. Basically, we have a main volatility barometer that takes all of my volatility metrics into consideration. And so right now it's at 68.8%. And then each of these three strategies they are all diversified across three different levels. So the first level is that they use different assets, right? So SVXY, QLD, which is 2 times the NASDAQ, and SPY. Now, like I said, these are correlated, but they're not exactly correlated. They are different. So there's a level of diversification there. And then the safety positions are definitely diversified. Real estate versus utilities versus gold. There's a lot of diversification there. So our, 3 holding safety position of gold, real estate, and utilities is a pretty solid position to be in. So that's the first level. The second level is the thresholds are different. So as you notice, the 3 dials, they're not switching positions all on the same day at the same time. We have to diversify them further by having different threshold levels. And the third level of diversification is that they're all using slightly different metrics. So this one, tactical volatility, being that it is the most hyper-focused in the volatility space, this is inverse vol, long vol, and then gold as a safety. This one is geared slightly more to the VIX futures specific metrics. So the ones we've talked about already. The adjusted M1, M2, the VX30 to VIX roll yield obviously plays a large part of that. The defensive, this one is geared, and I will use the word slightly, this one is geared slightly more towards cash VIX term structure and, cash VIX oscillator. Some of my other metrics that you will see in the emails, it's geared towards a couple of the other ones. They're just weighted a little bit higher, right? And the third one, strategic tail risk, is weighted more to the S&P 500 specific metrics. So you're talking about, things like volatility risk premium and whatnot. They are all slightly different. So hopefully that answers the question that, yeah, they're not super different, but since I do diversify across 3 different levels, I do feel like those three strategies, even though during very good times, stable times, we're just going to be in SVXY, NASDAQ, and SPY. And you'd think, oh, well, why would you even bother holding all three? Why don't you just hold one of them? They're all the same. They're actually very, very different strategies. So that's why. Okay. We're past an hour. If I want to ever do this properly, we have to cap something, right? There's way more questions than I could ever get to. In normal times, we expect the futures M1, M2 to be above the VIX spot as part of a normal contango layout. This is true. And being above VIX spot also encompasses a positive roll yield, and we expect the futures to slide slightly lower. This is more a test of my reading skills on the fly here. Where was I? Especially M1 as we get closer to expiration, becoming closer and closer to VIX spot. I'm still with you. Thus, if we see M1 and M2 below VIX spot, we see it as an unusual layout that encompasses a potential danger, since now supposedly we have a negative roll yield. Okay, good. This is still going. But thinking of it from another perspective, if M1 and M2 are traded below VIX spot, doesn't it mean that investors think the VIX spot is overpriced? Okay, there's a twist there. Let me finish it off. And is expected to go down, which should have been more. Oh, I kind of get what you're saying, but I think the better way to view it is it's not really a pricing of what you think is going to happen, rather than it is a pricing of what is a fair price for those contracts. Like, the longer you go out in time, the more uncertain things get. So the reason that the VIX futures term structure goes into contango and backwardation isn't necessarily for the reason that you're thinking it is, because people are, I mean, technically, I guess it is. People are pricing out different, but it's more that the longer the time frame in a normal, stable market, you need to be paid extra to be compensated for taking on that additional unknown risk, right? 4 months out, a lot of bad things can happen compared to 2 weeks. So you would think in a normal market that there would be an upward sloping contango curve. So when it goes into backwardation, all that is saying is that for a very short temporary period of time, that's when things are switching from traders actually expecting the opposite. But the long-term stability of a market does require a volatility risk premium. It has to be that way. So when it deviates away from a standard, normal, positive volatility risk premium, being implied versus historical volatility, historical being what we have already seen actually realized, implied being what people are expecting, that has to be higher long-term most of the time. So when it flips opposite, it doesn't really matter what people think is going to happen. That has flipped and it's showing the danger signal. So I'm getting the feeling that this is more of a semantics issue here, but I view it a little bit differently. I view it as it's not really a here's what I think is going to happen type thing. It's more that options should be priced. You should sell things that are overpriced and buy things that are underpriced, and that's the mechanism. I feel like we're talking about the same thing. I don't know. That's a tough one. That's one that I'm going to have to think about. I don't think I did that answer justice at all, but I think right around your fifth statement here, this is where our view of the dynamic changed, where you are viewing it entirely from a trader's speculative position. And I'm viewing it more as a functional options market perspective. We're going to get to the same answer, but I think we view it a little bit differently. Sorry. Can't knock them all out of the park. That was a bad answer. Does futures play a part in your portfolio? Nice to see a lot more people here. There aren't a lot more people here. There's something wrong with the YouTube algorithm. I hope there's more people here. Welcome, everybody. Smash the like button. I promise you'll learn something if you come back in the future. Please, I'm begging. No, just kidding. But yeah, there's probably only 60 or 80 people, somewhere in that range. Are you guys still here? I just had an error message saying that I have to shut down Twitter. So bye-bye to the Twitter followers. I should wrap this up anyway. So where were we at? Does futures? No, not really, because I try to keep things simple, and we talk about ETFs and options, tactical rotation strategies and whatnot. Futures, options, they're quite similar. There's a lot of overlap, but it would require an additional level of education. I'd have to make more videos. I'd have to answer more questions. There's really no reason to trade futures if you already are trading options. It's just kind of the same thing, slightly different way of going about it. So no, we don't do any futures trading of any kind. And personally, in my own trading, I don't either. I don't see any point. Sometimes you can negotiate lower fees, but it's typically reserved for those doing huge volume trading. Yeah. I don't know what the thresholds are. I personally had advantageous fees at Interactive Brokers because I did contact them. So like worth a shot, right? This is a great point. Thank you for bringing it up. It's a great point. What's the harm in asking? Send your broker. They're going to look at your activity, of course, and they're going to see if it's actually worth it. But yes, if you do trade significant volume, or if you are a very regular trader, or perhaps even if you have some type of position within the, I don't know if that would be beneficial for them to have certain people who use their platform and talk about it on live streams. If you have 150,000 YouTube followers or something like that, not sure if they'd go that far. But yes, some people do get preferential treatment. It's just one of those things. So you could consider that. Another thing that I don't really talk about a whole lot because it's not the magic, the magic wand that people think it is, but portfolio margin might make a difference as well. It's small and the algorithm's smart. You can't game the system. It knows what it's doing, but you could look into that, stuff like that. How's the legal process in Dubai to trade American instruments? Am I going to get in trouble by saying I have no idea because I've never bothered to check? Did somebody at the high up accounting just listen to my my statement there? No, I honestly don't know. For anybody who doesn't know, I live in Dubai. I'm in Taiwan now. I live here about half the year, but I'm a tax resident of Dubai, so there's no taxes there, at least until 2026. And I have no idea. I never bothered to check. I would assume nothing. Like Dubai's, we've talked about it many times. In my opinion, one of the best places in the world, but they don't bother you about anything. The win question was about U.S. election. Oh, God, I'd way rather answer about Baturbiev and Bivol. I think I said both of their names 3 different ways, 3 different times. It's a confusing fight, but Bivol's going to win. U.S. election, who's going to win? Well, I've talked about this in the past that, first of all, I'm neutral. I hate them both. So let's get that out of the way. I'm not red or blue team. I'm not even an American, so who cares what I think? But I'm at one of those crossroads where the person who I think is going to win versus the person who I actually want to win are different people. And so it causes a little bit of a, I guess I don't really care because I'm just one of those people, and you can disagree if you want, but I'm just one of those people that doesn't think anything changes either way. I just think that it's like a giant shipping, 400-meter shipping cruise ship that you can't turn that thing. Like it's just the U.S. economy, the military, the regulations, the judicial system. It's just going. And look, was there really a difference between what Trump did in his term? I mean, honestly, all the people that love Trump, I think a lot of them have forgotten that he was already president, right? We already saw this movie. I don't think we need to see it twice. He's not going to get a whole lot done, right? You might love him. You might think, oh, he's just the greatest thing in the world. But he did make a series of campaign promises, and none of them came true. So it's just a very large machine that even if we would assume that maybe he had intentions to change a few things, nothing happened. Like it just didn't happen. And I don't know how hard he tried, but let's just take him at his word. He did. It just didn't work, right? And Joe Biden comes in and, you might think that everything went off a cliff. I don't think it's any different, but I'm looking from the outside in, so I don't know. But, I just don't think anything is really going to change that much. But I'll answer the question because I don't care. So I think Kamala Harris is going to win. I really do. I think that not because of her, not because of anything to her. I just think that a generic Democrat that doesn't say too many stupid things should actually win an election in the U.S. in 2024. Just demographics-wise, unless she does something really stupid or Trump does something really great, if it's just sort of a generic on both sides, just demographics wise, the blue team should win, right? And I want to say blue team because I don't want people to think I like Kamala Harris. I think disaster of a person, but I wouldn't hire her to run a lemonade stand, let alone a country. But blue team should win a generic race. And so this is just my basic assessment. I don't think she's done anything incredibly stupid yet, and I don't think Trump's done anything incredibly brilliant yet. So in a head-to-head competition, like Trump of 2016 was a juggernaut. It was clear that he was to be taken seriously. 2024 Trump is not the same guy. He's more negative. He's less about policy helping the lower income people and the manufacturing people, and all the campaign promises that he made. They sounded fantastic in 2016. But like I said, don't forget he was already president. We've seen this movie before and nothing happened. But yeah, he hasn't done anything brilliant yet, and Kamala hasn't said anything completely disqualifying yet. So generically, blue team wins. But I talked about this a little bit on my last live stream that just on a gut instinct level, I'm actually a little bit worried for my American friends. And again, I'm not American, so this doesn't affect me. I'm a Canadian who lives in Dubai. Who cares what I think? But I'm a little bit worried what's going to happen if Trump loses. I really am. I'm not worried at all if what happens if Kamala loses. Pretty much nothing, right? Most people will just say, didn't want her anyway. But if Trump loses, the country could legitimately break. I think it could be a serious problem. So I'm not saying I'm on the red team. I'm not saying I'm a fan of the guy. Like I said, I've seen his presidency already, and I wasn't overly impressed. I wasn't less or more impressed than any other ones, but I just kind of hope he finds a way to win because I am genuinely concerned about the sheer number of people who are just going to assume that their country was stolen from them and what's going to happen if he doesn't win. I do not know. Hopefully nothing. Hopefully, if he loses, which it appears right now, I'd say it's about 60-40. Hopefully nothing. Hopefully people just okay, let's just calm down. Nothing was going to change either way. This is the United States. It's got all the checks and balances. It's a great constitution. It's all of these things. It's going to be just fine. It's the best economy in the world. It's the most influential country in the world. It's not going to break. Everything's going to be fine in the morning, right? Hopefully people understand that the U.S. is still the best place that it is before and after the election happens. So, fingers crossed there's nothing crazy. Fingers crossed the right person wins. Fingers crossed the person who loses doesn't think that there was anything shady going on because I hate to break it to a lot of people, but evidence matters in the world. And unless you can provide evidence that there is significant voter fraud, which I have never seen any, the winner's the winner. And this is another thing I've never really said, but I think it might make a few people angry. Thankfully, we're an hour and 17 into this live stream, and most people have gone off. But let's just say, for the sake of argument, that the election was rigged. Am I crazy? I mean, kill me in the comments if I'm crazy for saying this, but wouldn't you want that party to be in power? Because I feel like most presidents are totally inept on both sides, right? They've never really changed anything for the better, right? But if you could actually, in a country of 330 million Americans where it's basically split 50-50, if you could actually be a party that could rig an election in plain sight where 50% of the country wants the other result and you successfully did it anyway, that to me shows a level of competence that would be surprising. Like I'd be like, damn, that's impressive. You rigged an election where half the people are watching you and wanting you not to win. And you've got billionaires funding super PACs, ensuring that you don't win. And you successfully rigged an election in the US? That's a level of competence. I mean, like corruption, sure, but a level of competence that you'd at the very least have to respect. You'd be like, that's kind of impressive. I mean, am I crazy to have that thought in my head? Am I the only one that thinks this way? That I think most politicians are totally inept and in it for themselves. But if you could show the kind of coordination that would be required to rig a national election, wow, that's beyond the capabilities of what I thought that these, lame duck presidential nominees and conventions, Republican, Democratic conventions, and, the Senate and the House and what all these people, I just don't think they're competent enough to be able to do that. So if if one party showed unbelievable coordination to that point, I'd say let them win. If they're that good, maybe they can fix the economy as well. I mean, if you're good enough to rig a national election, I think you can handle fixing healthcare, right? It's really not that complicated when your GDP is $30 trillion or whatever it is. So I put enough on the table for most people to hate me. So let's call it there, an hour and 20. And you can kill me in the comment section. I think it's kind of fun to talk about, but again, it's such a non-factor to me anyway. So cool. There are some questions. Let me just do my standard, just in case some of them disappear. I do like to just keep a record of the ones that I skipped, and I will try to come earlier next time, ask them immediately, and then very good chance I will get you the next time around. So thanks, everybody. Hit the like on your way out, and I will see you all next week.